All right, so let's get back to the topic at hand, retirement plans. One of the things I think that you find is that, many organizations, they set up this pension plan, and it's like they create the document with the help of someone else, and they take it and they put it on the shelf and they kind of forget about it. And one of the things that you have to realize is, pension plan is kind of the double-edged sword. There's positives to having it. It's great for your employees. It builds morale. It helps employees save for retirement. But there's the negative aspect of it too. The negative aspect is, you've got a lot of oversight and regulatory stuff that's happening with respect to pension plans. And if you make a mistake, you can kind of trip a landmine and run into a problem. So we're going to be talking about a lot of that today. We're going to be talking about some of the common mistakes that we see out there. And actually, I believe there's an agenda slide, so I should probably get to the agenda slide. Yeah, nice job. So we're going to be, kind of going over a bunch of different things. So we'll be talking about, some of the landmines that are out there and some of the things that you need to worry about. Benchmarking, socially conscious investing, investment policy statements, and the like. So this is a small group. If anybody has any questions, please just chime in and ask. We want to make this as interactive as possible. And that goes for the people who are watching on the webinar too. If you have a question, just post the question and we'll have it answered within the room. So again, this is your time for the next hour and 20 minutes. So whatever you feel is important, whatever you want to ask, just chime in and ask. So.
Great. Excellent. Thanks, Ken. So as we jump right into this, the usual disclosures. This information is provided, of course, for no legal, no tax, no specific investment advice. It's really for informational purposes only. For anything big, you have to come and talk to Ken and I, right? Specific and be unique to your situation. So you can scroll through it a little more. This is how we always start, right? So why be in this room, this presentation? Not just because Ken and I are just really dynamic and really interesting individuals and extremely good looking, might add. Ken asked for that. That's why I wrote it down on the slide. But the why now? So really, there's just more rules. There's more regulations. There's just more, right, to deal with in retirement planning space. For many, many years, they were basically unregulated, especially for the nonprofit world. 403Bs were really the Wild West. That has really been closed down a lot in the last handful of years. It comes up all the time. You can just Google in terms of anything that you need in terms of 403B, what's going on with it, rules, regulations, legislation, and things coming. Simply, if you want to go after the money as the government, it's a really good spot to chase in terms of 401ks or 403Bs because are they a bank? That's where the money is. Why do you go? It's because there's a whole bunch of money there. The average fine from plan non-compliance from the DOL, $600,000. That's the average fine that's been assessed from plans not being compliant. So the goal for today is not to scare you into compliance, but to inform you, to give you some tools, some tricks rather, and to make sure that you're aware in terms of what's going on. Really, the real reason for this, I've always found, is that as a plan sponsor or plan fiduciary, you have to have some sort of consistent, thoughtful process. Don't just rely on your record keeper. So a Great West, ING, Mass Mutual, TIAA-CREF, whoever that is. They've got a limited bandwidth in terms of what they're able to help you with. If you're using a payroll company, which is fine, ADP, Paychex, whomever, great people, good service, they're also not going to be fully compliant on this stuff. Ultimately, the responsibility falls at the steps of the plan sponsor, who is the ultimate fiduciary. You're hiring, you're choosing the funds, you're hiring the folks that serve your plan. You've got to be knowledgeable on this stuff. So.
Go for it. We figured that you'd get tired of listening to one voice, so we're going to kind of bounce back and forth. So there are two main oversight agencies that are kind of paying attention to you if you have a pension plan. The first one is the Department of Labor. In 2015, the Department of Labor did a study. And what they did is they pulled audits that were done by accounting firms. So one thing to understand that if you have a pension plan and that pension plan has over 120 eligible participants in the plan, your plan has to be audited by an accounting firm. So they pulled the audits that were done by accounting firms, and they found that 39% of the audits were not done correctly and there were problems. So, the DOL is already, they were already looking at pension plans and already felt that pension plans were an important area to look at. And now they're looking at it and saying, well, even the watchdogs or the auditors who are doing the audits of these plans are not doing them right. So there's even, kind of more of an issue. So what is the DOL looking at? the DOL is the main emphasis on fiduciary breaches and prohibited transactions. So again, as Mark mentioned, the plan sponsor is the fiduciary of the plan. So you have certain responsibilities that you have to put in place. And if you're not doing what you're supposed to be doing, there's a problem. That's part of what the DOL is looking at. The other thing is, prohibited transactions. In the course of a pension plan, there are a lot of individuals who are related in essence to the plan. You have your custodian who's holding the funds, you have your third-party administrator, you have your auditors, you have the people within the organization, you have your board of directors. So they want to make sure that if there are transactions with these related parties, that they're done at arm's length. A lot of times you'll find, especially in the nonprofit world, the nonprofits will have somebody on the board who's handling the investments of a pension plan, and then that in and of itself may not be a problem, but it could be. So you have to kind of look at some of these things. And what the DOL looks to do is if there's something that's being done wrong, and again, remember, the DOL is Department of Labor, so they're focused on the employees. So if something is done wrong, they want to make sure that the employee is made whole. So a lot of the penalties that are imposed are monies that the plan sponsors are going to have to put back into the plan to make their employees whole. So if you do something wrong, you don't get the money into the plan fast enough or anything else, and we'll talk about all of that as we go through this, they're going to be looking for you to make the employees whole because they lost investment return, they didn't get the money in fast enough, and that's not necessarily the employee's responsibility to fix it, it's yours. On the other side, you have the Internal Revenue Service. They're also looking at these plans. Some of it comes through direct plan audits, and some of it comes through when they come in and do an audit of a company. They often will couple the plan, an audit of the pension plan when they do the audit of the company. They're looking at plan compliance. So are you following the rules and regulations that are outlined within the Internal Revenue regulations? And if you're not, they're actually looking to impose penalties and take money back. So DOL is looking for you to put more money into the plan to help the employees, and the IRS is looking to take money from you and use it for wasteful spending that the IRS normally does.
Just gonna throw in, those are the two people you don't want to mess with. You don't want to mess with the Department of Labor, and you don't want to mess with the IRS. So those two people, typically when they come in, they find things. There's a reason they're coming in, and just assume that we go through the process of trying to help keep them out, right? Or tighten up your procedures so when and if they come in, you're all squared away.
Want to click to the next slide? Mm-hmm. So one of the things we've seen is an increase in the number of pension plan audits. So even though you've had a government shutdown, even though there's tightening of resources within the government area, they're still finding the ability to come in and do pension plan audits. So what triggers a pension plan audit? Well, 21% of them are coming from complaints from your employees. So if the employees feel you're not doing something right and there's a problem, they're going to complain to the Department of Labor, and that can trigger an audit. Random selection. Just like any other audit, you got the chance of being randomly selected. You can get that golden ticket. I got the golden ticket. And third is, you do something wrong on something that you file with the government. Remember, you're filing a tax return every year called the Form 5500. If there's errors or things that are on that Form 5500 that trigger an audit or that don't seem right to the Department of Labor, that could trigger an audit. So you have to also make sure that if you have someone preparing that 5500, that they know what they're doing, that there's some oversight and review of that 5500.
When 5500s went digital, clearly it was a heck of a lot easier for them to query and audit 5500s, because if a box wasn't checked, they could just say, give me every retirement plan in the certain zip codes or in all of New York State that didn't have a fidelity bond, which is a check the box, right? Hey, I have one. You're legally required to have one. Could be an oversight accident, but now a letter automatically goes out. So it was a huge spike when everything went digital. So just keep in mind, as things become and progress more digital, you're just going to have an easier access for the regulators to oversight.
The other thing you have is there have been lawsuits where employees have been suing their employers regarding pension plans. So kind of think of it as, no good deed goes unpunished. So some of the bigger ones have happened in the for-profit world, but we've seen over the last few years some of these lawsuits happening where some of the major universities have been sued by their employees. And some of those lawsuits, I think there was one recently settled where it was settled on behalf of the nonprofit or the university. But again, those lawsuits, they're looking at things like the Plan expenses are too expensive. You know, you're paying too much for plan expenses. The investment alternatives are not necessarily the right investment alternatives. You've given me too many options and I'm paralyzed. I don't know what I'm supposed to do. You haven't educated me enough. And those are all things that we'll talk about as we go through this. But those are all areas where you can kind of trip up. And that's, again, what we're trying to help you with here. So when the Department of Labor comes in and does an audit, you know, what are they actually looking at? Some of these we'll talk about a little bit more as we go through. But timeliness of your deposits. So you're holding money from employees, you have to get it in within a specific period of time. And we'll talk about that a little bit more. If you're not getting it on time, it's a problem. Compensation, how would you define compensation? Because the definition of compensation within the plan is extremely important. And if you're not complying with the definition of compensation, you have an issue. Distributions, employees want to take money back out of the plan. Are you making appropriate distributions? Are those distributions timely? Are you withholding the right taxes from those distributions? Are you doing proper trustee to trustee transfers? Payment of plan related expenses. Some plans cover some of the costs of administering the plan. Are those allowable costs? Are they appropriate? Are the expenses that a plan are paying too expensive? What's the funding policy of the plan? How are you funding the plan? And are you complying with the plan regulations? What's the investment process? How do you ensure that the money is being properly invested? How are you reviewing? Do you have an investment policy in place? Do you have prohibited transactions? I talked about that before. I mean, are you having transactions with related parties, and are they at arm's length? The accuracy of the Form 5500, I mentioned that's a triggering point. That's one of the things they're looking at. Are you appropriately bonded? Mark mentioned before that that's a little checkbox on the 5500. And if you don't have appropriate bonding, and we'll talk about that a little bit more, again, something that they're looking at. Participant force out provisions. You could have provisions within your, and the last two here are things that they, that they've been kind of spending a little more emphasis on, but participant force out provisions, you can have something within your plan that forces, if the balance is $5,000 or less, you can force people out of the plan. Are you following that appropriately? Are they getting all the money that they're supposed to be getting? And then reporting and disclosure. So when you're sending in the financial statements, if there's something within those financial statements that trigger a problem or isn't consistent or isn't with in accordance with guidance, that could also trigger an audit.
Thanks, Dad. Hey, man. It's all good. Selfishly, as a third-party administrator and retirement plan consultant, we always say that the most important thing about retirement plan is the design. Arguably, it's the most important step because oftentimes when we see retirement plans that are brought to us by employers or colleagues, and we're asked to look at, the first question we ask is, all right, well, why do they have this? Not just why do you have this fund or why do you choose this record keeper, but why is this plan in effect? Is the real intention to recruit and reward and retain valuable staff? Because it can be a great service tool, right? Retirement plans can be great for that because that backs into all the provisions in the plan. How soon are you making your employees eligible? For non-for-profits, 403Bs specifically, they're universally available, which means part-timers are eligible to join your plan. So unlike their counterparts can have 21 and 1,000 hours of service before they're eligible, you don't get that with a 403B. So that's a thing we typically see a lot with non-for-profits, so they don't realize that. So for example, if you're looking at a match, which comes very often, right? Match denotes dollars. Oftentimes people don't realize as a plan sponsor that their match formula is entirely up to you. You don't have to match dollar for dollar capped at a certain amount. You could match 50 cents of a dollar and therefore motivate your employees to perhaps put twice as much money as they otherwise would away to get that in, right? So just as an example, sometimes people don't realize that those simple, easy tweaks make a material impact. Several years ago, right, automatic enrollment came into full effect in vogue. Fred Reish, who's one of the industry gurus who goes out there, talks all the time in Washington, has his own plan. He factored into his own plan a very productive and maybe innovative way of doing it. Every year when his plan resets, I believe it works on a year, right? So January to December. Every January 1st, his plan auto escalates, auto enrolls people who hadn't otherwise voluntarily joined, and rebalances every one of his employees back to a target date fund. Maybe heavy-handed, but he's an attorney and he's an ERISA guy. So, if someone wants to remove out their plan back to a fixed account, whatever their model is, they can do that the very next day. But he believes so strongly in it that he just pushes that in. So I will tell you, in 20 years of doing retirement plans, we've seen a lot more of these provisions come into effect. I can't tell you how many times we even look at retirement plans and they still don't have a Roth provision available. Stood up in front of a group of 78 doctors the other day, and doctors are great people, right? Help us do a great service. But sometimes doctors are smarter than everybody else in the room. Maybe it's just the education upbringing. One of the gentlemen in the back raised his hand. He said, I can't have a Roth. My tax advisor said I make too much money. I said, well, that's true. You can't participate in a Roth IRA, but if you have a Roth in your 401k, you absolutely, doc, can do this. People don't realize sometimes that the language in this industry was never meant to be easily digestible. So keep that in mind. Thank you for the throw out there, Jerry. So keep in mind that sometimes when we're looking at retirement plan design, that is the most important thing, right? So we always say start first with the end in mind. Design is really important. 457 plans, really interesting, especially for nonprofits. 457 plans are limited to tax exempt organizations. So you have to be tax exempt to get a 457 plan. Most common, you see them in municipalities. Typically, those deferred comp plans are something that people don't take advantage of because maybe they're already participating in their 403B. But 457 plans can be a really unique tool to carve out a certain benefit, maybe just to those key executives that you want to recruit or retain to an organization. It's a great tool, and the numbers don't run concurrent. And I'll give you, for example, I'm under 50, so I can do $19,000 to my 403B. If I was covered by a 457 at that organization, I could do $19,000 on top to my 457 plan, or my employer could contribute on my behalf to a 457 plan. Pretty cool, right? 457 plans also have unique catch-up provisions. So within 3 years of retirement, you could double up your deferrals. So you could save $38,000 for the last 3 years of retirement as soon as you're over age 50 and do maybe your $19,000. And I'll give you one instance. My father worked for a town organization for many years. Within the last 3 years of his work, because he didn't have income growing up, we had income at the end of his retirement years. I had him squirrel away as much money as he could afford to put away into the plan, right? Might as well. So just keep in mind that there are great tools that can be out there that you could use on top of existing plans you already have. Defined benefit plans have been around forever. We always call them top hat plans. I always get the visual of a guy wearing like the black brimmed hat, kind of all buttoned up. Why? Because typically you see a 403B or 457 plan for some portion of that and a defined benefit plan on top, because that's where you're squirreling away a lot of money. Certain rules and regulations, you need to involve an actuary with a defined benefit plan. And defined benefit plans are typically limited in terms of this use because there's a big cost. But I will tell you, cash balance plans have been out for several years, last 10 years, right? We've been using them a lot more because they just work so well when you're really trying to benefit a group of employees. Last but not least, there's always non-qualified plans that I'm not going to educate you fully on today, but you can use life insurance as a tool. It's a non-traditional retirement sort of benefit where you can structure things to benefit certain people with a non-retirement plan, right? So something that's functioning like a retirement plan, because really a retirement plan is whatever you call it, right? As something. Do you want to add to that? No?
I mean, one of the things that when you're looking at your plan design, I mean, you need to kind of understand what is it that you're trying to accomplish. So what is it? What are your goals when you're kind of setting up the plan? Because there are a lot of different ways that you can design a plan and a lot of different features that exist within a plan. Some of the things that Mark talked about in terms of, I want to have the plan have auto enrollment, things like that. But then there's also different types of plans themselves within both the defined contribution area and the defined benefit area. By the way, does everybody know what the difference between a defined benefit plan and a defined contribution plan is? The words, right? Right. The contribution is very different from benefit. Yeah. So no, but a defined contribution plan is one where what's defined is the amount of money you put into the plan. So you determine how much you're going to put in the plan, and then those monies are invested, and whatever the investment return is and it grows to, that's what you get at the end of the plan. So it's the amount that you're putting into the plan that's defined. A defined benefit plan, it's what's coming out of the plan is what's defined. So you will be in a situation where under a defined benefit plan, you might be getting 60% of your compensation, or let's say you set it at, you're going to get $100,000 a year for the rest of your life. That benefit is defined. So then you have to determine based on actuarial calculations, how much money has to go into the plan in order to meet that benefit. So that's why when Mark said defined benefit plans are so expensive, they're expensive because it takes into consideration mortality of people. It takes into consideration how many years they're going to be retired before they start collecting the money. With people living longer, you have a situation where you need to put away more dollars in order to meet that $100,000 a year for the rest of your life. So what you find is that the defined benefit plans used to be very, very popular with businesses, and businesses have gotten rid of them because people are living longer. It used to be people retired at 65, they died between 67 and 70. You'd have to pay out for a couple of years and that was it. Now it's not the case anymore. Now people are living much, much longer. So the retirement years are much longer and you're paying out for a longer period of time. So the only places where defined benefit plans you typically see right now, and you can correct me if I'm wrong, which is what my wife normally does, but the only place where you actually see them anymore is you see them in government, school districts, and you know, the police and everything else. So government agencies, and you also see them.
Yeah, white collar firms, right? Engineering, accounting.
The other place is doctors. Doctors, we don't have many accounting firms. We don't do that. The other place you see them is doctors. Doctors' offices where you have maybe like a sole proprietor, like a sole doctor. Those, or a doctor with just a couple employees, they can really sock away a lot of money in a plan like this. So again, you know, there's from a design perspective, you have to actually understand what is it that you're trying to accomplish. And once you determine what it is you're trying to accomplish, then you can design the plan to accomplish what you're trying to do. So again, if you're a business owner and you're trying to direct a larger portion of the contribution to yourself and less to your staff, you can do that. If you're a cost-based reimbursement funded nonprofit organization, where you have different programs, some are cost-based, some are fee-based, and in some programs you're overspending, in other programs you're underspending, you could actually design a pension plan that will allow you to give money to the employees in the areas where you're underspending so you can maximize your reimbursement and not give dollars in the areas where you're overspending. So there are many, many ways that you can kind of utilize a pension plan no matter what business area you're in. And the good thing about a pension plan is pension plans don't have to be funded until after year end. So if you're in a situation where you're trying to spend your money and you're not sure based on regulations how much you actually spent until you after the end of the year, and you kind of figure it out based on allocation of costs and everything else, a pension plan set up the right way gives you the opportunity to sock away dollars after the fact, after you've been able to reconcile everything and figure out where you actually came out. So again, it's a really cool vehicle that you can use.
Great. Well done. So summarizing everything that Ken had just said, which I think he did a great job on, as always, that you can clearly use your retirement plan as part of your overall total compensation philosophy and really use it to drive your organization's philosophy, right? So we're way past just having a plan and allowing employees to save on their own, right? So many organizations are doing some type of a match. Many still are doing 457 on top. Some still are doing that defined benefit cash balance type program for wherever it makes sense and fits. Working really with a knowledgeable third-party administrator whose job really it is as a separate entity from yourselves as the plan sponsor or the organization that is the record keeper is the prescribed best practice method to make sure that you can once in a while pull your plan apart, make sure all the provisions are still what you wanted and understand. Because P.S. when the DOL and the IRS come in, they ask for a litany of things. Ken and I have been involved in organizational audits like this for our respective and mutual clients. The first thing they ask for is your plan document and every iteration you've ever made to it. So I'll just say that again because I think it's really important to repeat. So it's good, right? So they're going to ask for every document that you've ever had and every change you've ever made because your current plan iteration, you like the iteration, and every iteration you've ever made. It's better than change. That's true. It's change, only better. Here's one that's really interesting and very in the news, kind of new age right now. Socially conscious investing, although really new in terms of the industry and the space, the concept's been around forever. It was around since the 80s with apartheid. It's crazy stuff. So there's a lot of different buzzwords when you start talking about socially conscious investing. ESG, SRI, you have religious beliefs that you can factor in. There's a whole bunch of benefits to offering socially conscious or environmentally friendly sorts of investments. We see this substantially more in non-for-profits or nonprofits than we do in our for-profit organizations. Typically, I think that's just a cultural fit. It just fits better to the organization's culture. They believe in certain things as a nonprofit, hence they want to extend that out to everything that they do. Maybe we have some clients that are green organizations. They're so green that they even buy recycled paper to use. Instead of buying brand new reams of paper, they buy recycled paper. I don't know what the cost is on that, probably higher, but they believe so much in everything that they do, they're extrapolating that through everything. That does extend to your retirement plan. So a few examples, right? So it is conceivably possible that you may have restrictions that are something like, I don't want to invest in anything that invests in guns, pornography, alcohol, tobacco, things like that. And you can put those restrictions on your plan if you choose to. Make sense? The other piece to that, though, however, is although there's very little use, unilaterally across the industry for this, there is a very high level of accountability for doing so. So let's say that maybe I have certain beliefs that I want to extrapolate to my organization and hence to my employees. You have to sometimes separate yourself as a person from your role as a plan sponsor. It's really important because the Department of Labor and the IRS do not denote a difference. It's another good word, denote. Yeah, it's not musically. Denote a difference between employee and participant. So if someone worked for you and was in your plan and left your employment, are they still a participant in your plan if they had a balance? Yes. Do you still owe them the same requirements as any other participant in your plan? Yes. Why? Because in the regulations, they don't denote a difference between a current and a former employee. They're in your plan, period, the end. You owe them the same requirements, the same responsibility, the same liability, potentially as you as an organization, as anyone who's currently in your plan. So keep that in mind, because typically when you separate service from someone or they separate from your employment, there's a reason they're not there. They weren't a good cultural fit. They moved on to greener pastures, whatever it was. Sometimes the best practice is help those folks get that money out of your plan. They don't know you, you don't know them. Help them move on to another place. I think Fidelity does a good job with that little green line commercial. Maybe you guys have seen that, right? Hey, the little green line that goes back, and oh, it's my old desk, it's my old job. Oh, I left my coat behind the door and my balance in my 401k plan. So I need to remember to move that stuff. So they do a good job of kind of helping move that stuff out. But back to socially conscious. You don't want to just push your beliefs down to your retirement plan because the government has said you've got to make sure that you're still prescribing to a thoughtful philosophy in terms of how you choose, select, and monitor the funds in your plan. So the DOL's got some guidance on this, with candidly, like a lot of government stuff, is sort of nebulous, probably because part of the rules and regulations are written under one administration and the most recent stuff's written under another, and those two administrations didn't function the same way, right? We deal with this now all the time in the government. So if you're adding or monitoring or continuing to have a plan that has a socially conscious fund or series of funds, you have to make sure that it is a good fund or a series of good funds. You can't just put a fund in there that is really specific to halal investing or compliant with certain laws, beliefs, or otherwise, if you're not monitoring that as you would any other fund. The last bullet point on here I thought was kind of interesting. I found this useful stat on the Employee Benefit Research Institute. Less than 8% of all plans, which is a lot of plans, right? Less than all plans have even a single fund offering. And we've seen a ridiculous increase in this interest, especially from the non-for-profits that we serve. The interesting part of that, however, is that when you do offer a plan option that is this, the employees' beliefs in terms of your organization do increase. So they think you're a cooler, snazzier organization because you're being a little bit more environmentally or socially conscious. It's kind of good. You like that one, Bob? That's good, right? How do you monitor this stuff? Well, in the retirement world and in many aspects of the investment world in general, you have to have on an ongoing basis some sort of investment policy statement, which I grant sounds really, really sophisticated. It's actually very simple. Just like if you were hiring someone to come in and redo your kitchen, right? There's going to be a scope of work, there's a job thing, there's a whole layout, there's an architectural drawing, and what do? Right? As now you're general contractor of your own project, right? To redo your kitchen. I love when you use analogies because people like they get engaged because retirement sounds so foreign. Oh, a kitchen? I'm involved in that. The person's going to walk in, they're going to say, Bob, you're an early morning guy. Jerry, you entertain a lot at night. So we're going to talk about the things that we're going to put into this kitchen that make it fit for you. You're both left-handed, so then we're going to move the kitchen's flow around so that you got more left-handed space because you cut with your left hand, etc. It's no different when you're designing retirement plans or administering them on an ongoing basis. It's got to fit you. Your investment policy statement fits the scope of why did you pick these investments in the first place? How often are you monitoring them? What are you monitoring with an outside service, or you're monitoring somehow inside? And when and if you change something, is it compliant with whatever your investment policy statement is? So when I say that, people kind of like, they gravitate, oh, that makes a lot of sense. Yeah. So that way you can hold your broker, your advisor, your record keeper accountable for whatever investments are in your plan or have been removed from your plan, because that's one of those pieces that the DOL and IRS will come in and ask for on an ongoing basis. This is considered best practice. Typically, these documents are pretty boilerplate. You don't need a heck of a lot of customization for them. If you don't have one in your plan, one of the easiest fixes is just get one, right? Ask the providers that you work with, hey, do we have an investment policy statement? Because if we do, I don't know what it is, and we're the plan sponsor. Even if you're the person that's remitting the money in the plan, you're considered a fiduciary by fact of touching that money. So take that into account.
How many of you guys know that you have a investment policy statement? A couple of you. So again, something as Mark mentioned, that's a takeaway. Go back, make sure that you have one in place, and make sure that, yeah. So, and again, that's extremely important, make sure that you have one. Another question for you. How many of you, another thing Mark mentioned, how many of you are meeting with your investment advisors on a regular basis and reviewing the plan assets to see that the plan assets are still appropriate? Again, few of you. Again, another one of those takeaways, something that you really should be doing. There should be a regular conversation. I kind of look at things, and we'll talk about it a little bit more, but I kind of look at things from almost like the traffic light. You've got your red light, your yellow light, and your green light. If a fund is working effectively, and it's getting good returns, and you look at it from a risk return perspective, it's working well. That's one that gets the green light, and that's one that you just continue to have in the plan. If maybe there's a few hiccups within the plan, within the fund, gets a yellow light, and it's one that we're going to be watching. And then if there's one that's really completely underperforming for the risk that you're taking, and there are better funds out there that can do the job more effectively, that gets a red light, and you really should be thinking about changing that fund. So again, it's a process that you should be going through with your plan administrator, with your investment guys. So before we get into some of the common retirement plan errors that we see out there, does anybody have any questions? We designed this so that we had enough time for you guys to ask a whole lot of questions. So, we really want you guys to be kind of focusing on questions here. We like to hear your voices, not just ours. Okay. So the question was, one of the things that we said was, the goal is to try to push employees that are no longer working for the organization out of the plan. But if we do that, a lot of times the fees will go up, because the more people, or especially if the participants are paying for the fees, that gets divided over a larger group of people and a larger asset base, right? One of the things I can tell you, a couple of things to keep in mind. First of all, as I mentioned earlier, if you're a smaller plan and you're starting to push up against that 120 employee limit, your fees are going to go up dramatically if you need to have an audit. So if you're sitting at under 120 employees within your plan, one of the things you definitely want to do is you want to start paying attention, because again, if you get dropped up above that 120 mark, and it's where you are at the beginning of the plan year. So if you've got over 120 at the beginning of the plan year, you trigger the fact that for that year, you're going to need an audit. You have to now get all the way down below 80 before that audit requirement goes away. It's not like, oh, I had 121 and now I'm down to 119. So therefore, we're good now. We don't need an audit anymore. No, it's once you get over that 120, you have to drop below 80 before that audit comes off the table. And an audit can cost you, $12, $15, $20,000, depending on, what you're looking at and the type of the plan. And it has nothing to do with assets. It has to do with the plan itself and the work that has to be done within the plan. So again, something to keep in mind. you definitely want to try to, if you're not over that 120 employee mark, you definitely want to try to get people out of your plan. And when I say try to get people out of your plan, again, you have to have the provision within your plan document. You can't get people out that have, I would send them letters and stuff, but you can't automatically throw somebody out of the plan if they're over $5,000. So stuff like that. If you're under the 80, you're fine. It's once you crawl over that 120 that the problem occurs. But one of the things that you have to kind of keep in mind is if you do a little hiring spree, or maybe you have 80 or 90 employees, but there are still 30 people who left balances within the plan. It's something that when you look at your 5,500, and a lot of times you get the form 5,500, it's like, okay, good, it's done, sign it and throw it in a drawer. You should really take a look at that, because it'll actually show you how many plan participants you have at the beginning of the year and at the end of the year. And that's kind of important to keep in mind. And just because you have a certain number of employees at the end of the year doesn't mean that that's the starting point for the next year, because you could have open enrollment effective January 1st, and that could trigger a new batch of enrollees into the plan. So kind of keep that in mind.
That is a challenge, right? So that's why we preface the whole presentation by, it's generic advice, not custom to your situation. So every plan is going to be different. Every situation is different. But I will tell you that most of the time when plans are being repriced and rebuilt today versus even 5 years ago, it's not really asset driven. It's participant count driven, because it's a race to the bottom in terms of fees for most of these plans. The older days, especially non-for-profits, everything was bundled up in the fee. And you're right, there was break points the higher the asset went. So it was counterintuitive to you as the plan sponsor, but beneficial to the record keeper. And that's why they built these things that way, right? So, the more you had, they can afford to take a little bit incremental less at a fee, because they still had all these assets. So now what we find is that when we're seeing plans repriced and repricing these plans for our clients, you're going in at almost an institutional asset class. It's one flat fee, regardless of how much assets you have or participants. It's a fee. So you can either pass that fee, absorb that fee as an organization, or have some combination therein. So therein lies maybe an opportunity for you to look at your plan. Hey, does this still fit? Because we don't want to have people that used to work here that we're leaning on their backs and they're leaning on ours to do the right thing, but we don't include them in our meetings. We don't send them correspondence, because they're not an employee. And I just want to make that clear. Employees and participants are not the same thing. Someone in your plan is still someone in your plan. You owe them every right, everything that you did to someone else that used to be an employee. So just make sure, because we've gone through this many, many times, there is no denotation in terms of difference for DOL and IRS. Participant is participant, employee has no bearing on it. So former employees, doesn't matter. They're still in your plan, they're in your plan. So generally speaking, the best practice advice is to help those folks get out.
Yeah, I know there's more questions. I just want to add one more thing to that. One of the requirements you have, and it's something that the DOL is kind of clamping down on right now also, is these lost employees. So you have employees who have left the plan. They no longer work for you. They still have account balances. You still have a requirement to send them information on an annual basis. So if you don't know where they are, or if they've moved and stuff, you could run into a problem if you don't go through some due diligence to try to find out where they are and follow up. So it could end up costing you more money to do all of that follow-up for these people who have now moved and you don't know where they are. So you kind of have to take that into consideration too. I know before Bob, we get to you, there's a question on the webinar.
Oh, you cross that over to me.
I can do it.
That's fine. I'll take it. So the question from the web was, is it better for the advisor cost to be a set amount or percentage of the assets? So I wouldn't say that's a definite maybe. That's the answer I'm going to go with. It's a definite maybe. Kidding aside, it is really a definite maybe, right? Because there is no unilaterally correct answer to any of these questions. Everything spindles off into a different area. So not knowing the particulars of the situation, I would say it really depends on the demographics of the organization, the participant count, the flow of money coming in, the current asset base, the terminated participants, all those things factor into it. And what I would say is best practice advice is run both and project them out with the current flow of money that's coming in, any contribution and match, and see where those tiers go and fall off.
Yeah. One of the things that the Department of Labor, though, is also clamping down on, as we talked about and we'll talk about more, is these fees. And when you're looking at these fees, one of the things to keep in mind is if I've got a plan that has $5 million worth of assets with 100 participants, and because of a good stock market, the investments grow to be $10 million with the same 100 participants, if you're paying a percentage of the assets, DOL looks at it and says, well, why does the broker get more money because the assets have doubled if he's not doing any more work? So again, keep that in mind. That could trigger a problem with the DOL also. Bob, you had a question? So the question was, if I have a participant who's in the plan who no longer works for the company, how do I continue to provide education to that individual outside of what I provide for my employees because they're no longer there? Again, I think it comes down from an education perspective. You can push information to them. There's certain legal information you have to push to them. They need to get their regular statements. They need to get the plan summary, the annual notices, all of that stuff. So they need to get that information. And Mark, you can tell me if I don't know that you have a requirement to invite them back in to do education to them. You have a responsibility to provide them with regular information that you're required to provide them with, and that's it. If they're no longer there, you have a child grows, moves out, you're no longer responsible to feed them, or maybe you are in my case. But that's right. But again, the point is, you got to kind of look at that.
Sure. So a follow-up question came in, which is what is the ongoing requirement in terms of education, right? In terms of how do we provide this advice? And we can break it apart as a broker or as an advisor, consultant to the plan, right? So some of that is going to clearly be limited by the advisor's relationship with their broker dealer or their licensed firm, right? Based on licensure, what your broker dealer relationship allows you to do and provide, and they're literally all over the place. So when the rules and regulations changed, we saw broker firms not want to be involved. So unless you had a certain designation, you couldn't even sell plans. If you didn't have a certain number of plans, you couldn't sell a new plan unless you were partnered up with somebody. There was a very interesting kind of dynamic that came out of the industry from that. Because people that aren't what they call RP or retirement plan heavy advisors, the industry on average, just across the board, kind of said, all right, well, we're not going to let you guys do plans, guys and gals do plans, because we just don't think you're going to do it right. And as a broker dealer, we're worried about the end customer, and selfishly, they were worried about getting sued, right, because of something wrong. Because this is real, guys, right? Although you're a plan sponsor and you don't worry about that side of the world, the people who advise and consult and service your plans have to be knowledgeable on this stuff. So one is, how do you do it on an ongoing basis, assuming you're allowed to do it? One, and the best practice is always leverage to the fullest extent, hilt, whatever your record keeper custodian services are. So let's say you're with some very large record keeper custodian, American Funds, Capital Bank and Trust, whoever, to Empower, huge organizations that have very large plans, right? And are big and have continued to be big for years. They've got every conceivable medium out there, right? They can send text messages. They can do automatic, organizational pushes on a constant basis. It's not just limited like the old days. It's not just limited to once in a while the broker comes in and buys pizza for the organization and has the people show up and talks to them about why they should be in the plan. So you should absolutely leverage all those mediums as a consultant. As a consultant, if you're limited to what you can do or what your consultants are limited to do, then I would say as a plan sponsor, you leverage whatever else is out there, and there should be something else, which I think is also kind of snazzy. So an investment policy statement in the industry goes under an IPS, investment policy statement. There is such a thing as an education policy statement, aptly, right? Okay, EPS. So that EPS, education policy statement, is how do we get access to the employees on an ongoing basis? How do we get access to the participants? Probably better worded, right? Here I am telling you the difference between employees and participants and made the old mistake. How do you get access to those participants on an ongoing basis? What's the best way to push them information? How do we want to do it? How are we doing on an ongoing basis? And what is our requirement? You need to have those participants get every notice that otherwise any other participant would get in the plan. And as a plan sponsor, it's a seemingly endless supply of notices that you're required to do, from the summary material modifications, summary plan descriptions, the annual notices for Safe Harbor, if your plan subscribes to Safe Harbor. And hopefully some of those regulations that the government is considering and enacting will push out to even be more responsive to use what mediums we're all using today anyway, like digital delivery for a lot of this stuff. Because right now it's still in a gray area of, hey, can I just digitally drop it in a box? Well, for most of us, if you have access to a computer or a smartphone, yeah, of course. Most people have access to those things. But now what if you're in an organization, an industry where a lot of the blue collar folks, maybe there's a language barrier, maybe they're just not sophisticated, they don't have access to a computer. It opens up a door of questions. Did I answer your question, Ms. Hines? Yeah. Sure. So let me repeat the question. So the question was, the woman in the back was under the assumption that once you left the employ, of your current organization, you were required to move your money out. So again, going back to what we started with, this is your plan document is the ultimate governing instrument of your retirement plan. So you can have a lot of provisions in there. The most beneficial for most organizations is to have what they call a force out or directed rollover provision, which means if the employee separates from service, if they have a balance under $5,000, but more than 1,000, you automatically roll them over into an IRA. With due notice, of course. You send them the letter, assuming the letter gets to them. Hey, within 30 days, if we don't hear back from you in terms of where you want this money, we're going to roll it over into an IRA, typically associated with your plan. So if it's Empower, you're going to roll it over to some Empower-related IRA, and then Empower will send you the correspondence. And when you want your money, you can go find it. It's effectively out of the plan. If it's under $1,000, same notice goes out, right? Hey, you got some residual balance in the plan. If it's under $1,000 and you don't tell us where you want this money, we're going to cut you a check. You're going to pay taxes and maybe early withdrawal fees, but that's within your right as a trustee to do that. And you cut them a check to clean out these low balances. And I think that gets to a point that we had asked earlier, which is, why do we want to clean some of these folks out? Sometimes there's just big body count and low balances. That doesn't help most plans, right? Clearly, if you had a balance that was, a substantial material portion of the overall assets, maybe those folks you want to keep, or maybe they were executives of the organization or some key folk. Maybe you don't want to be so heavy-handed with them. But for the rest, there is no requirement to force anyone out of a plan once they separate from service, other than just giving them advice and guidance. I'm sorry? Oh, no. So once you're separated from employment, the only way of getting money into an employer-sponsored plan is because of your relationship with the employer. So they could segregate money from your paycheck and deposit it in the plan. I apologize, I didn't repeat the question. The question was, once you're separated from service, how do I contribute making money, contributions to that plan? The answer is you can't, because you're no longer employed by that organization. So you can have that balance sitting on that books, hence that Fidelity green line commercial. I left money here and there and everywhere else. I can go and clean up all my old balances and roll them over into my current employer plan, current job, or to an IRA of my choosing, wherever it is I have my money. Sometimes there's a lot of benefits to that, just to make your life easy. You consolidate all your assets in one spot. Plus, there's some provisions that you only get on your active plan, like being able to take a loan, right? For her first-time home purchase, borrow money up to 50 grand, pay it back over 15 years. That's kind of nice. You don't need anyone's permission for that, other than having your employer process the forms. So, that answer your question? Sure. So the question was, so when the plan is annually tested, so we talked about your 5500 filing, which is your governmental filing, essentially like a tax return for your retirement plan, summarizes everything. And again, guys, that's public record. So it's anyone can go out there. It's free. You can download anyone's 5500 because it's a public filing. When the plans are tested, and the testing is done to make sure plans are not discriminatory, benefiting some and not others, and that is allowed so long as the provisions dictate it and the plan passes applicable testing. So when the plans are tested by your third-party administrator at the end of every plan year, the question became, those old folks that had balances in the plan, are they included? Yes, they're still participants in the plan. So they still are tested as part of the overall plan. Yep. Yeah, yep, correct. So even if they're no longer employed, if they're still in the plan, they're part of the plan, and the plan is tested with everybody who's in the plan and everyone who is eligible to be in the plan. That's another one of those errors, although I noticed we probably didn't put that one down, Ken and I, as we get to some of these later slides. It's a common testing mistake that when plans are tested, and we've taken a lot of these plans over, I feel like, in the last handful of years, typically by organizations that were well-meaning, but they submitted just the folks that were in the plan to have it tested, and that's not how it works. You test the entity of itself. So you test the entire employer with anyone who would have been eligible in the plan. That goes on the 5500 report, not just the folks that are in the plan, right? So it's active employees and participants. Typically that number, as you guys would correctly surmise, is bigger than your active employee base. Let's say I have 25 employees. I could conceivably have 45, 50 employees in my participants in my plan, right? Active employees, former employees who never left, who never cleaned them up, and the plan just kind of grows by extension. Yeah, so the question, follow-up question was, what about, why is the benefit to then push some of these folks out? One, from a liability perspective, almost entirely. Maybe secondarily from a cost perspective, depending on how the plan was built. So liability first, cost perspective second. I also would make the argument that you're doing the right thing by the employee to remind them that they have a plan, and perhaps it makes sense for them to move it to their new job or to an IRA of their choosing. And that is clearly within your rights as a plan sponsor to do that. The rules have been pretty heavy-handed with that in terms of you absolutely need to do this as a requirement. But last, why would we kind of push them out? It's not typically going to help you pass testing. Typically, it's going to help you with potentially an audit if you're bumping up to an audit requirement. Hey, I've got 120 participants in my plan, but I only got 100 employees or maybe 80 employees. Well, maybe you should be looking at this as part of your annual review of your plan. And I say annual because really every 3 years is best practice to really pull your entire plan apart. Do I have the right funds? Do I have the right custodian? Am I working with the right brokers at the right firm? Ask questions of everything because you can, right? Most of us are not using a phone that's 4 or 5 years old, but yet we have a retirement plan with all of our retirement money in it that's maybe 10 or 15 years old. We keep making little changes. Guess what? Technology changed, right? So some of this stuff needs to be looked at more frequently because things change and costs come down. So I would say every year you should be doing a once over on your plan. When did we do the enrollment meeting? What was the results of that? How many folks are in our plan? How much are they deferring? Do we need to change our match? Is there any rules that have come out to warrant a change in our language in our document? Every handful of years, 5 or 6 years, you're legally required to restate your entire document because there's been a bunch of little iterations that factored in. I mentioned Roth provisions some years ago. That was like a midterm amendment. Most people don't amend their plan every time the government comes out with a new benefit. So every 5 or 6 years, the government says, hey, for everybody that's got a plan, everybody's got to restate them by a certain date. We're going through one of those dates right now. So by April of 2020, anyone that's got a 403B plan has to restate their entire document. Typically, a third-party administrator or your record keeper is going to charge you for that. So if they're going to charge you, I always make the argument, what better time to do a second opinion review of your document by someone who's not your current provider, because they're going to ask the questions that maybe you don't know to ask or that someone's been burying, right? Because they're going to say, why did you have this? And why do you have this? And why do you have this? And are you aware of this?
Have you thought of this?
Right? Yeah, I like that. Have you thought of this? So did that answer your question, sir? Okay.
Bob, do you have a question?
Oh, good.
Always good when they can read your mind. Oh, we're on this slide. So some of the common errors that we see in retirement plans, and these are things that we come across when we go and do audits of pension plans. This is kind of our short list of errors. So one of the things is not keeping plan documents up to date. And then again, this is what Mark just talked about. Things change within your organization, rules change. How you do business changes, how you pay people changes. You could add new provisions or bring on new programs if you're a nonprofit organization that get funded differently, so you're paying your staff differently. So again, what you need to do is you need to kind of review all of that, and as Mark mentioned, it should be done at a minimum every 3 years, but it might be good to do it once a year. But that's something that we see all the time, where we see that organizations are just not complying with their own plan document. Second, understanding compensation. You would think that's fairly easy to understand. Okay, you got paid, but what constitutes compensation? And in your plan document, it spells out what constitutes compensation, but a lot of times employers get it wrong. When you're looking at compensation, what about overtime? Does overtime come into play in terms of compensation? What happens if I get a stipend because I'm getting paid a stipend to do something special, or if I get a bonus? And so when I'm talking about this is, so let's say I have an employee who's making a contribution, and their contribution is going to be, that for, they're going to contribute 5% of their payroll every time to their pension plan. Well, if they get a bonus, and bonus is covered under the plan as the plan says that it's total compensation, all forms of compensation, you need to take 5% of that bonus too and put that into the plan. And if you don't, you're not complying with the plan, and you could run into a problem. So these are the things that we see all the time. Are you sitting in a situation where if you're doing a payout for vacation time because people didn't use all of the vacation time? Again, that's part of compensation. So you have to go back and look at what it says within your plan document in terms of what compensation is. But I can tell you that's probably the most common error we find. We find almost on every single audit that we pick up and start looking at a new plan, we find problems with how they define compensation and how compensation withholdings and stuff are being handled. Yep. Stay with the new fingers. Not making timely deposits. This is number one on the DOL's hit parade. A lot of times, so let me explain what that means first. So you withhold money from people's pay, right? and you have to now take that money and you have to put it into the plan. It's got to get distributed to all of the employees, and they can start earning money on that, right? So you're in a situation where you have the money withheld, right? And you have to contribute in. According to the regulations, as soon as you can segregate those funds from the plan sponsor's assets, you have to contribute that. So what does that mean? Well, if you're using an outside payroll service and the outside payroll service is determining how much that pension contribution is, pretty clear. You've given them all the information, they do the calculation, they say, oh, you have to make a pension contribution of $5,000. At that point in time that they tell you it's $5,000, you should be able to make the payment in and put the contribution into the plan. A lot of people think because the plan, because the regulations state that in no event should you be making a contribution more than 15 days, that's a safe harbor. It is not a safe harbor. You do not have a 15-day safe harbor. If you can typically segregate the funds within 1 or 2 days, then that's when you can segregate the funds, and the funds need to be contributed within 1 or 2 days. If you're contributing it within 15 days and it's past that 1 or 2 day mark, you could be responsible for making up the loss of investment return that your employees had. So that's something you got to keep in mind. There is a safe harbor for plans that are under 100 employees. You could go up to 7 days. So that is a safe harbor. But for the larger plans, there is no safe harbor. As soon as you can segregate the funds, you're supposed to get them in. We typically tell our clients, think of it from a 3-day perspective. I mean, you really should never be putting those funds in more than 3 days after. So that's something to kind of keep in mind, 3 days. Still on the same slide. Not following eligibility requirements. So how do you notify your employees that they're eligible to participate in the plan? What protocols do you have in place? How many of you have an employee handbook that spells out within the employee handbook what the rules and regulations are? Pretty much most of you. How many of you make your employees sign the employee handbook? Good. That's good. Because if you have the provision in there and the employee signing the employee handbook, you've got proof that you've told them what the eligibility requirements are. It's still good practice beyond that to send out some sort of correspondence to an employee when they become eligible. It's even better practice, as Mark mentioned before, to auto-enroll people in the plan. So when they become eligible, they automatically get put into the plan, and then it's up to them to decide if they want to come out of the plan. But again, part of your goal is to help people put away money towards their own retirement. Did you have a question back there? There should be specific, if you're going to rely upon the eligibility requirement being met through your employee handbook, then the eligibility requirements must be spelled out within your employee handbook. I'm sorry, the question was, when you're looking at eligibility, does it have to be specific wording within the employee handbook, or can you just say CHR for eligibility requirements? And the question was, does the enrollment process need to be spelled out within the HR manual? And Mark, correct me if I'm wrong, but I don't believe the enrollment process needs to be laid out, but it's when do you become eligible? What are the time periods that you can get in? So what's my enrollment period? So if I have open enrollment every January and every July, that should be spelled out. It should be spelled out, whether it's you need 1,000 hours and 21. So if it's 1,000 hours, once you reach the 1,000 hours, if the next open enrollment period is January, that's when you get into the plan. So that should all be spelled out. So the question that, or the statement that was made was, in order to help to ensure that the employees are reading the handbook, have them review the handbook on while they're at work. So this way, they're getting paid to review it, so you know that they're actually reviewing it. So if you allocate an hour for them to review the handbook, and they're going to get paid for that hour, and then they sign it, you can then say, look, it's our policy to provide an hour for them to read the handbook, and therefore, we've done our part to ensure that they've met the obligation. So I think that's a good point. Any questions? Couple other common retirement plan errors. Improper loans and hardship withdrawals. So your plan has to provide for hardship withdrawals. You can't just allow hardship withdrawals to happen if it's not included in your plan. Same thing with loans. The plan has to have a loan provision. If your plan doesn't have a loan provision, then you can't allow employees to take loans out of the plan. Failure to perform discrimination testing. I think Mark already talked about this. That's, again, one of the big things we find where they don't perform the discriminatory testing, or they're not using the right factors and data to perform discrimination testing. Mark mentioned earlier that you might not have all of the eligible employees in that testing. Failure to file accurate forms. So when you think about forms, there's the 5500, and I mentioned before that if you don't file an accurate 5500, that could be a triggering impact for DOL to come in and do an audit, or the IRS to come in and do an audit. But there's other forms that you have to file too. If somebody takes a distribution from the plan, at the end of the year, you have to file a 1099-R that basically says they took a distribution, what they did with those funds, where the funds rolled over, or were they taken personally and taxes withheld. And if there were taxes withheld on a quarterly basis, you have to file a Form 945 and make sure that the monies that were withheld are remitted to the IRS. We find, I'm sorry.
So you may want to add that the forms that are typically filed, those forms that Ken's referring to, sometimes and typically, especially in maybe more robust plans, the record keeper custodian will assist in filing those forms. But again, ultimately, it's your responsibility to know, are those forms being filed on our plan's behalf? Are we required to do them? Sometimes there's this gray area. They'll do some, but not others. So you just want to know. And that's why I said sometimes that once a year kind of quick and dirty of all the highlights of your plan's provisions. What are you doing? Whatever. You don't have to pull everything apart, but you got to start asking the deeper questions other than, oh, we got a lot of money. The market went up and we saw you we saw you 6 months ago. ACEs, great. That does not fulfill your fiduciary responsibility in the least. So don't be lulled into that kind of trap of, I have a close relationship with an advisor, and the advisor comes in and we do a meeting and he asks me a couple of questions and we make some recommendation, we move a fund around, and that's it. There's a lot to this now, and the government keeps hitting us with a lot of rules and regulations of, here's this finite list of things you have to do, and if you're not doing them, you're not compliant. So
one of the things I mentioned before, failure to locate lost employees. Again, you have a responsibility to be making or providing information to your participants, and whether those are employees that continue to work for you, or those are participants that left account balances, you have a requirement to provide information. You have a requirement to track down. You can't just send a certified letter and say, hey, here's your statement, and if the form comes back that there was no one there to sign, put it in your files and say, hey, I've met my obligation. With the internet out there and the ability to track out people, you really need to go through the process of trying to track out the individuals. You need to document what procedures you did to try to find these individuals. And if you can't find them after a period of time, obviously you have to remit those monies to the state, so that the state can have those unclaimed funds. So the question was, is it the employer's responsibility, or is it the responsibility of the advisor? The employer ultimately has the final responsibility in this because they are the fiduciary. It depends on the arrangement that has been set up with the advisor. So if part of our arrangement is that you're going to be responsible for doing this, then you need to be doing this as the advisor, but I still need to monitor to ensure that what we've paid you to do is being done. Because while I can push off, and we'll talk about this in a few minutes, so I can push off some of my fiduciary responsibility, I can never absolve myself of all of my fiduciary responsibility. So the question is, as an advisor who's a co-fiduciary, you also have responsibility, and the answer is yes, you also have responsibility to find that ex-employee. It's not easy for me to say. Nothing's easy for me to say. It's actually my first day with a new tongue. So one of the other things you have here is fidelity bonding. So remember, Mark mentioned that you have to check off a box to say whether you have a fidelity bond, but you also have to make sure that the amount of the fidelity bond is appropriate. And the requirement is it's got to be 10% of plan assets up to a maximum that you require to have of $500,000. So if you see a growth in your plan assets because we have a good market, you have to make sure then that you've kind of provided or go to your insurance company and get additional fidelity bonding if your bonding is not enough. And again, that's an area where we see problems.
So just to add to the fidelity bond, so the fidelity bond, just understand, a fidelity bond benefits the employee participant, does not benefit removing you from fiduciary breach. right? So fidelity bond is required because you have people in the plan and you're ultimately responsible for the money. So this is to make sure that the money just doesn't disappear, right? So again, that's that requirement. Typically, these are really cheap. We sell them all the time as part of the plan. It's a couple $100. Typically, even further still, you can get a plan fidelity bond that auto ratchets. So every year we just make notice, hey, the plan assets went from here to here, and it goes up and there's no increase. There's no cost differential to the bond because it's just a big block that we have in terms of bonds. So keep in mind your service providers may have that too. Ultimately, it's a box that needs to be checked. You should have it. It's not very costly. The other thing you may want to consider as we jump into slide 17 here in terms of best practices, we'll talk about fiduciary. There is such a thing as a fiduciary bond, which is more expensive, but will typically cover you in some form or facet from unintentional fiduciary breach. Remember, nothing is going to cover you from an intentional breach. You misappropriate money, you didn't remit the money, you did something wrong with the plan, you're liable. That's just the way it is, right? No insurance policy covers your car if you intentionally drive into something else, right? Just the way it works. That's counterproductive to the concept of insurance.
So we have a few slides left and we have about 9 minutes. So
I'll talk really fast. So the benefit of best practices is we've covered most of this stuff. So we talked about educating your staff. We've talked about RFP benchmarking your plan, which is really a good process once every 3 years to pull everything apart, reprice everything, and reprice everybody's services, your TPA, your record keeper, your advisor, etc. Number 3, consider hiring a fiduciary. I'm going to spend a minute on this since fiduciary is such a buzzword and sort of confused. So sometimes fiduciary tasks, which are tasks that are required to be done by the plan, there's a presumption. I think gentlemen asked the question before, I'm a co-fiduciary to the plan, or I have a co-fiduciary on a plan. Unless it's stipulated in the contract, assume it's not being done. So I would assume that then, Bob, that if you're a co-fiduciary to the plan, you're not required to do anything unless it says that you're required to do it. Right? Because most of the time when you're working with, let's say, the payroll partners that we work with, where the payroll company has a payroll solution and they're going to tie you into a plan, they're going to remit the money. Remitting the money to the plan is a fiduciary task. Most of these service agreements, however, specifically exclude any liability for them acting as a fiduciary, which means ultimately it's still on you as the plan sponsor. So don't be lulled into a false sense of security because someone's doing me a favor. And maybe you do this for your plans all the time, Bob. You're a great guy, so I don't doubt that you would. You'd help out as much as you can. But remember, ultimately, unless you're acting as a fiduciary and raising your hand, yep, I'm a fiduciary in the plan, or I'm named in the document, you're probably not getting that level of coverage. 2 things to talk about with fiduciary, the 2 numbers which are important. I want you guys to take your pens out and write this down. 338, 3 sub 38, 3, right, parentheses, 38. A 338 is a co-investment fiduciary. This costs almost nothing in your plan, but brings a lot of value. Why? Because now you can no longer be sued for investments. It costs you typically 5 basis points, 0.05% of assets. And now you're no longer involved in the investments at all. You don't pick them, you don't monitor them, you don't manage them. You just manage the relationship that you have with that investment person. That's it, done, it's home run. Very simple, very cost efficient. So you should really be looking at working with 338s. It's a cheap, easy way to get out of dealing with investments as it relates to your plan. Nope. It's an agreement. It's a service agreement. Yes, the question became, what percentage of advisors are 338? I'll tell you that the top 1% of all retirement plan consultants in the industry, top 1% now, this is crazy, have 5 plans that they serve on as advisors. So if you have 5 plans or more that you serve on as advisor, you're in the top 1% of all advisors in the entire country serving plans. Most of those folks, ironically enough, are not 338s because they don't want to do that service and provide whatever broker consulting services they're providing. So I don't know the exact number, Bob, but I would say it's probably very little, although it's increasing all the time because it's cost efficient to do so. So again, a 338, which was the other part of this question, is a separate agreement you'd have with an outside investment company that just picks the investments for your plan, monitors them, and replaces them without asking you. What did I just say? That's right. They're not including you in the discussion. Why? Because if you're included in the discussion of where we eat as a restaurant, guess what? If the restaurant meal stinks, it's your fault, not mine, right? Because we chose it together and we both said we were going to go eat here. Man, Jerry, I love that you laughed for me. That's fantastic. It makes me feel good. Yeah. No. Incorrect. Yeah, so I'm going to repeat the question. So the question becomes, at some point in time, the plan sponsor has to tell the advisor what investments they want, and the answer is no. because the rules say you have to offer a diversified menu, you have to have target dates, you have to offer some default investment vehicle, and none of that tells you, well, we believe in this. Now, if you work with a 338 that will allow you to have input in the process up front, which is maybe where you're going with this, sir. Hey, we believe in socially responsible investment. We'd like to offer a socially responsible fund. Can you find us one fund that subscribes to this? And we go from there. So the question is from the web, is it true that you are still responsible for overseeing or being a fiduciary to choose? Absolutely. So again, you can never fully remove yourself as a plan sponsor, plan fiduciary, unless you just don't have a plan, right? That's not really good for most of us. So you still have to have the plan. So remember, hiring someone to outsource that liability is still a fiduciary task. So again, like I said before, don't get lulled into a false sense of security because someone says, don't worry, I got this. You got this if you got this piece of paper that says that you got this when you got my back. It's not like, hey, you got my back, you can buy me a cup of coffee on the way into my DOL and IRS audit. You got my back, like you're going to sit there in case I get sued, you're going to cover me with it too, right? You're bonded, you're insured, you're liable, and you're stipulated in your contract. What are you doing for the plan? Right, so that's the 338. Remember the two numbers I wanted you to write down? The other one is really fast, which is the all-encompassing fiduciary, 3/16. That is a co-administrative fiduciary. That's the golden unicorn, a co-administrative fiduciary, right? So 338 is very easy, right? Outsource the investments, I'm done, I'm out, 5 basis points. Co-administrative fiduciary is covering you as a fiduciary for all the other administrative tasks involved in running the plan. Tracking eligibility, loans, payments, everything else, right? Those are clearly a very stipulated and very finite list of what you're looking for. That may mean that they're moving the money from your payroll to your 403B or 401k and making sure that the money got there. If money rolled in or rolled out, that person's signing off, and typically that person's named by name in your document. So they are literally a co-fiduciary. They're not acting as one, they are one, right? That's a big difference. So a co-investment is 338, a co-administrative is 316. If you have both, you're about as good and compliant as you can be. So you may want to look into both of those things. Not everybody offers these services as part of that bundled solution, but those are good things to do in a best practice. I'm going fast? Yep. How are we doing? How are we doing on time? 2 minutes. 2 minutes? We'll go really fast. Pension law changes, this is all you, man.
Okay, so we've got 2 minutes and I've got 2 pages. So these are the next couple slides deal with some potential laws that are coming down the pike. They're not set in stone yet. One of them is the auto enrollment safe harbor cap. So there's a cap right now that if you're on auto enrollment, you can increase the amount that's contributed up to 10%. So that's the maximum you can automatically have withheld is 10%. It's now going to be going up to a maximum of 15% if this proposal goes through. Second, there's a safe harbor notice requirement. They're going to be eliminating the safe harbor notice requirement. Again, if the proposed regulations go through, there'll be a new credit. So if you start providing an auto enrollment provision within your plan, the government will give you, based on the amount of the eligible employees, they'll give you anywhere between $500 and $5,000 credit that you would get over a 3-year period of time. So that's good. The repeal of the minimum age for traditional IRA contributions. Right now, if you have a traditional IRA at the age of 70 and a half, you can't contribute anymore. They're talking about repealing that so that you can continue to make contributions into an IRA past the age of 70 and a half. There's a portability of your lifetime income options. There's allowability for long-term part-time employees. So right now, again, most plans have 1,000 hours of service in 1 year. They're talking about now, because there's a lot of part-time employees out there, that there would be either the 1,000 hours for 1 year or 3 consecutive years of 500 hours more to try to get more people into the plan. Because the goal of the IRS and DOL is to try to get as many people into the plan as possible. Question, Diane? Well, again, that's going to come up to whether your plan, the question was, does that provision provide a match? And that depends on whether your plan provides for a match. So if your plan provides for a match and they become eligible to participate, then they would get the match too. Increase the required age for minimum distributions. Right now, if you're over 70 and a half, you're required to take a minimum distribution. Because people are living longer and retiring later, they're looking to change that from 70 and a half to 72. So that's when you would be forced to take the minimum required distributions. the plan's adopted due date. So one of the big things that you have right now is if you want to set up a pension plan, you have to set up a pension plan by the close of the year. The new provision would allow you to actually set up a pension plan by the due date of the plan return. So that gives you extra time to get a plan in place. So this is great if you don't have a plan in place and you want to put one in after the year end, you can do that. There's consolidation of Form 5500s. There's really, you really have to have everything aligned with respect to all of your different plans in order for that to happen. There's a lifetime income disclosure to participants. So you have to let them know what their lifetime income is at least once a year, and there's safe harbors with respect to that. Sorry, I know I went through that really, really quick, but these aren't rules. We will continue to keep you abreast of if anything changes with respect to that. And if you go to our website, you know, on a regular basis, or Mark's website, that stuff will be posted as the final regulations come through. Couple things from any questions, first of all, before? Couple things from a housekeeping perspective. There was a folder that you got. In the folder, there was obviously the presentation. There was a little flyer here about 6 reasons to work with Magii. After you're done reading these 6, I can give you another 12. Some other stuff from Magii in terms of you know, what they do. There's an evaluation form. We do ask that you fill out the evaluation form. You know, the best you can give is 5, so that's what we expect. And then no, it's 5. And then there's also a little newsletter in here. It's our first inaugural issue of the pension planner, and it covers a lot of the information we covered today within here. Yes, I will sign it if you want a signed copy of it since it's first run. Any questions? I do want to thank everybody for coming this morning and participating in this. And I definitely want to thank Joanne and Capital One for making this space available. This is an incredible space, and they covered breakfast and everything. So awesome. Thank you.